So we specialize in real estate tax planning. We specialize in entity selection and structuring work, again, mostly for investors and small businesses. Why? Because simply by structuring your entities, you can save a minimum of $6,000 to $10,000, depending on what your income is and what kind of business you do. And that's just the starting point, by the way. So that's just the starting point as far as tax savings are concerned. We also do the regular tax preparation work for corporations, for S corporations, for partnership businesses, and the regular accounting work, again, for real estate investors and small businesses only. Why? Because real estate accounting is very tedious. It's very different, just because everything is just different for investors. Let's just put it that way. So is taxes and so is accounting. All right, moving on. So I haven't shared much anyways, if we were just on slide number 1, but thank you so much for pointing out. Let's move to the next slide. So Joe already introduced me, what I do. So the correct pronunciation of my name is Gunveen. People like to call me Gavi, whatever is easier for you. We specialize in real estate tax strategy. Yes, I do a lot of consultation sessions on how do I save money in taxes? How do I grow my portfolio? What can I leave for my children or for my grandchildren? How do I do inheritance planning? How do I do estate planning? So we do a lot of that, trust planning as well. We do not help clients set up estates or trust because that's something that attorneys do. But yes, I do consult on trust and estate planning for sure. We do help investors reduce liability and grow their net worth. Obviously, since taxes is one of the largest expenses for any business, uh, if you save on taxes or you pay nothing in taxes or you get refunds from the IRS in the form of your checks, then that's where you use that money to reinvest, right? So if you save 50, 60, 100K, 200K in taxes, 300K in taxes, that's basically all savings that you can use to reinvest into real estate. So definitely, if you're paying something in taxes, it's time to always think, how can I do things better? How can I improve? Maybe it's time to speak to some specialist, specialists in the industry who can help me reduce my tax bill. Now, all the clients are investor clients. Like I said, in real estate investors, they are full-time, part-time. We also work with syndicators, both from the GP and the LP side, which is general partners and limited partners. So if you invest directly into a syndication, into a multi-family unit of 300 doors, say, for example, you become a general partner. And you're a limited partner if you don't have the time to, invest. You don't have the time to go full time into syndications, into real estate syndications. That's when you invest your money, 100K, 200K, depending on how much, whatever, depending on different syndication to syndication, whatever the requirements are. And then you do not participate in the day-to-day decision making. You do not, since you don't have the time because you have a full-time job, you either are a small business owner. So your money goes in, you get a set rate of return, either quarterly or annually, or you get negative K1s from those syndications that can be used to offset against your active income. We work with wholesalers as well, and flippers. People are really serious about wholesaling and flipping in the country. Some of them are like, they do on massive scales. I mean, you can't even think about it, the way people flip and how they wholesale, based on contracts. Then we have private landlords owning properties in LA, in Manhattan, and they've built, you know, into generational wealth just by owning, residential property in one of the most expensive areas in the country. And like I said, we do long-term holds and short-term rentals, which is Airbnb, which has been fast upcoming since the past few years, and rental arbitrage. Uh, okay, so the website is, you can find us at gavtax.com, but again, more on that later on. So I'm sure most of you already know why real estate is a tax advantage investment. Simply because besides all the usual expenses that you can take for yourself, there's one more expense that your CPA, EA can help you take, and which is depreciation. It's a phantom expense. And that is calculated based on the type of property that you own, the year of purchase, and the fair market value of that property on the date of purchase. So that's something you're allowed to take year after year. If it's a single family home, it's a residential property, 27 and a half years is the time period for which you can take depreciation for. If it's a commercial property like an office or office space or a storage unit, things like that, then it's 39 years, which is the typical time period for taking a depreciation. The other way that investors benefit from is by going in for 1031 exchanges. So if you own property, a townhome, say for 150K, and you intend to sell it, or you will be hit with capital gains taxes. And some of the investors, they don't want to pay capital gains, so what they do is they just go ahead and consult a CPA, how do we go about doing this? What I generally say is go in for a 1031 exchange. We do not facilitate 1031 exchanges, but what we do is we put you in touch with 1031 intermediaries who specialize in these exchanges. So we consult, we tell you whether it's the right strategy or not. And secondly, we also help you prepare taxes, also do the accounting part of it when it comes to your books, for 1031 exchange. Now, capital gains could be long-term and short-term. I think the next slide is going to talk about capital gains taxes. Now, so investing into real estate is basically an opportunity for passive income generation, and then optimization comes later on. So all your active income is income from your W-2, income from your 1099, all your income from your business or multiple businesses that you own, that is all termed as active income by the IRS. On the other hand, passive income is income that you generate from your rental properties or by investing passively into businesses, maybe a car wash business, maybe you're a limited partner in a gas pump, or something like that, or a limited partner in a storage unit. So those are all sources of passive income. Even your rental income from your properties, from your investment properties, is all considered passive income. So real estate is definitely a great opportunity, a great area for you to grow your passive income. And passive income is taxed lower as compared to active income. So that's a difference. The other difference is active income is taxed all the way up to 37%. And that's just the federal tax rate. If you happen to live in the state of California, you're going to be hit with 10 to 12% more in terms of state taxes. So the high income earners living in the state of California will be hit literally up to 47, 49, which is literally half 50% of their income that they generate from active sources. So they are constantly looking, such people, high income earners, are constantly looking for ways to minimize their tax burden. And how do you do that? They start invest passively into real estate. The passive income, on the other hand, is taxed not more than 20%. So even though, so for federal, you get taxed all the way till 37%, anything between 21 to 37%. Passive income, you will not get taxed more than 20%. So that's why real estate happens to be a great place for you to invest. All right. So since we're talking real estate, I think it's going to be useful for us to mention or just talk about capital gains taxes. Capital gains taxes, there are two types of capital gains taxes. One is short-term and the other is long-term. Short-term gains, so if you sell a property, you buy a property and you sell it within say, less than 12 months, you're going to be taxed at ordinary income tax rates, which is going to be all the way up till 37%. But if you hold the property for 1 year and 1 day, so even if it's 1 year and 1 day, more than 12 months, you're going to be taxed at anything between 0 to 20%, depending on your federal tax bracket. So it's definitely beneficial to hold your property for more than 12 months because there's a huge difference, on how you're going to be taxed. The other taxes that might apply would be the net investment income tax, also known as the NIIT, which is 3.8% of your MAGI, which is your modified adjusted gross income. So in terms of capital gains taxes, what they like to do is they like to hold the property for more than a year, and so timing is most important. And in order to defer capital gains taxes, because this session is all about tax savings, legal tax deferment, legal tax savings, tax minimization, tax reduction. It's all about tax savings. The best way to defer capital gains taxes is by going in for a 1031 exchange or investments into qualified opportunity zones. We'll talk more about both the deferral tools in the upcoming slides. Okay, so there's another great tool that differs. Again, a very common question I get from my clients is, how do we save on capital gains taxes? How do we defer them? How do we not pay capital gains taxes, even if we've held the property for more than a year? And I think there are tools, like I said, 1031 exchanges and opportunity zones, but there's another great tool which is known as the installment sale. I have clients who do that, clients from Texas who do that. They do it for medium-sized properties to large properties. Installment sale is when you spread the gain over the year. So you sell the property, say for $200,000, but you accept the payment. So you set up a contract with the buyer. The seller sets up a contract with the buyer, and the payments get spread over a period of 20 years, 15 years, 10 years, depending on how you enter into a contract, whatever the terms of contracts are. And you get taxed as a seller. You get taxed only on the payment that you receive for that year. So you do not get taxed on the entire, say, 100K worth of capital gains taxes. You get taxed only on the payment that you receive, the interest income and the down payment money in the first year of sale. So installment sales is an excellent tool for you to save as a seller, to save money instantly in your taxes. All right. Moving on, there's another great tool for deferring taxes, which is a charitable trust planning. And it's only if the intent is to donate. So this tool is a little complicated, but it's given by the IRS. Some people like it, some people don't, it depends, so it's entirely up to you, but more on it later. All right. Okay. Now, this is, so bonus depreciation, cost segregation, these are all different types of depreciation, all phantom expenses that your CPA, EA can help you calculate on your assets. Bonus depreciation, it accelerates your property costs. You can write off the 100% of the cost of your assets in the property. It was supposed to be 60% in 2025. But after Trump's one big, beautiful bill that was passed literally 2 weeks ago, he said that the bill says that now you can write off 100% of the assets within that property, provided that the assets were placed after January 20th of 2025. So bonus depreciation is a big deal for investors. It helps you write off a lot of your assets in the first year of placement itself. Now, this applies to all your HVAC units, your improvements, your appliances, and it's great. It's great when you have any new acquisitions or any refurbishments, remodeling, or improvements on your property. Now, how do we suggest investors use bonus depreciation? You bought a Tesla for 100K, we write off a complete value of that asset, your Teslas, in the first year itself. So if you have income from your business, the value, the depreciation from the Tesla might help you reduce your overall MAGI, which is your modified adjusted gross income. You can combine your bonus depreciation with cost segregation. I'll tell you what cost segregation is in the next few slides. And it's a great tool. Bonus depreciation can be combined, like I said, with other types of depreciation, and therefore becomes ideal for high income earners to offset income in that year. So you need to consult with your CPA. Hey, it seems like I'm going to be making a lot of money this year from sale of property, or maybe just general income, ordinary active income from your business. Can you tell me what is the best way for me to reduce my taxes? So then obviously your CPA EA looks at he's a tax doctor, right? He looks at your tax return to see what are the opportunities, how much money is being left on the table. So we do all of that. You can definitely carry forward your unused deductions for future years. And yeah, we already talked about that the asset has to be placed after January 20th of 2025. All right, so we spoke about bonus depreciation, we spoke about capital gains taxes. The next great concept for investors, very, very lucrative, is cost segregation studies. This is, again, another form of accelerating depreciation on the asset components within a property. So if you own a single family home for 800K in a fancy neighborhood in Florida, and you did some remodeling work, you introduced, some cabinets or wiring, HVAC units, plumbing, etc., you can write off the value, complete value, 100% of the value of those asset components in the first year itself and use those tax write-offs. So it's a great tool. Cost segregation studies is something, is an engineering, is something that's done by architects and engineering. So it's a cross study, and not all CPA firms do this, simply because they're not licensed to do it. It's as simple as that. So it's best to consult a cost segregation intermediary who will conduct the study for you. And trust me, there's some really good ones across the country. Okay, so the assets, which are real assets, they're known as real assets. That's the category that IRS classifies them under. So they are so those assets have a value of 5 years, 7 years, 15 years. So what the IRS says is, why wait 15 years to write off the complete value of the asset when you can do it right now using a cost seg study? So besides depreciation, you can accelerate the writing off of those assets and save a whole ton of money by using those tax losses. All right. Retroactive studies are also allowed. So you place the asset, say this year, you placed your single family home this year, you did some work, major, refurbishments, remodeling, or whatever that you did, and you forgot, or your CPA did not mention to you, hey, get a cost seg study done. You can always go back and get them done as well. And you can use losses again to offset. All right. This is a typical example of how a cost seg works. It's very useful for multi-family units, especially people, who do syndications, both from the GP, general partner, and limited partner sides. So example is there's a multi-family unit, worth a certain amount. You get cost seg study. Cost seg studies will help you write off typically around 250 to 350K in the first year itself. And then those cost seg depreciation from those cost segregation studies combined with bonus depreciation can majorly, like literally, I've seen huge, massive results, and how it helps in, offsetting against your tax liabilities. Again, it's good for commercial for sure, but for residential properties, it depends on the fair market value of the property. If the fair market value of the property is more than 500K, yes, it's definitely recommended for you to get a cost seg study. But it really depends on you. I have clients who've gotten cost seg studies done for properties that are worth 350, 400K as well. So it's really up to you whether you want to get a cost seg study done or not. Why? Because cost seg studies can be expensive. The typical cost of getting a study done could be 3,000 to 5,000, depending on the size of the property. That is if you want to go through a firm of reputation, reputable firms who specialize only in cost-seg studies. So they can be expensive, but they're definitely worth the results that you end up getting on your taxes. The only issue with depreciation, we spoke about bonus depreciation, we spoke about normal standard depreciation, which is, and then we spoke about the accelerated depreciation, which is cost segregation study, is that even though you will end up taking, all those losses year after year, if it's 27 and a half years for residential properties, at the time of selling the property, at the time of the sale of the asset, you will be hit with something known as depreciation recapture tax. Now, this is something that the investors don't like. They're like, okay, you know what? First, the IRS gives us the incentive of taking depreciation, and then they now they want us to pay all in the form of taxes back at the time of sale of the asset. So why take depreciation? We also have clients who are like, oh no, this was scared of taking depreciation and all those phantom losses. They're like, you know what? We're going to be paying back all those taxes at the time of sale of my property. So why do I take depreciation? Now, this is where the concept of net present value comes in. It kicks in. A dollar that you save today is definitely going to be worth more in the future, right? So it's best to save money now, and who knows what's going to happen in the future, right? You might just end up doing a 1031 exchange, right? Or maybe you might just end up deferring your capital gains taxes by investment into a qualified opportunity zone program. So why worry about something that's not happened yet? If the IRS is giving you, if the IRS tax code for real estate investors says that you can take those, you're legally allowed to take those losses, depreciation losses in year 1, year 2, 3, 4 now, just take it. Just take them, take those losses. And trust me, they're huge depending on the size of the property, depending on the fair market value of the property. Now, depreciation recapture tax could be anything up to 25%, but that is later on. Like I said, don't worry about it. It's only at the time of selling the asset. So if you've taken depreciation and you sell off the asset, say in 10 years' time, you will be hit with depreciation recapture tax. But there are ways there's a turnaround. When I say there's a way to avoid not paying depreciation recapture taxes as well. All right? There's always a clever way if you speak to a smart CPA. All right. Moving on. This is one of my favorite topics. I get this question so much from my clients about the real estate professional status. Do I qualify for this? How do I qualify for this? Can my spouse qualify for this? Tell me more about it. So please help me get this professional status. I want to see this on my tax return. So this status is for clients who are full-time into real estate investments. And the IRS says you have to fulfill 2 requirements, which is the time requirement and the material participation requirement. So 1, you should be spending more than 750 hours on your property or properties, and more than 50% of your work time should be towards your real estate investments, towards your properties, towards whatever you're doing within the real estate world, basically. Now, this applies if you're married filing jointly. In this case, either you can take it or your spouse can take it. The both of you combined cannot take the real estate professional status. You cannot claim it. So people are like, no, can both of us take it together? No. It's either David or Martha. It cannot be David and Martha. All right. So moving on, we've spoken about the material participation. You need to be fixing things. You need to be calling plumbers. You need to be, calling, electricians, checking emails, getting those checks in, driving to your properties, things like that. The best way to claim it is to have to maintain time logs. The IRS has some templates. They are IRS approved templates that you can use to fill them in real time. and they can be kept as proof to substantiate yourself in case of an audit. This is one of the most audited statuses or benefits. So if you claim the rep status on your return, you're going to be audited. Let's just say, I'm sorry, I hate to say this, but the chances of audit increase. All right. But don't be scared. If you are an investor, this is what you do, then just go ahead, claim it. And again, there are clever ways around this as well. Lots of gray areas on how to claim this. Um, you convert passive losses to active. One major benefit, actually the number one benefit, is that this status, it helps you convert passive losses to active. So say, I'll give you a hypothetical example. You are a business owner. You make, I don't know, $1 million from your business. And on the other hand, your wife, she manages real estate investments. She manages, I don't know, 2 dozen properties or whatever. I don't know. And so your wife, so you claim the rep status for your wife. Martha claims it on their tax return, and we help them generate those paper losses, using those phantom depreciation and all that kind of those expenses. We create paper losses, so in quotes, okay. If you see my hands, my photo, paper losses, right? And those losses from your rental real estate properties can be used to offset against David's income, all of that business income. So if he's owing, I don't know, maybe let's just say 300K in taxes at the end of the year from all his business income, then those losses from the rental property, Martha's so-called business, can help offset all the 300K that David's going to be making in terms of tax payments that he might end up owing to the IRS at the end of the year. So he doesn't have to do that. Everything's going to get offset. Only if they claim the real estate professional status on their tax return. And they bundle up those properties. So there's another requirement that the CPA needs to do. He needs to show that those 10, 12, 15, 20 properties is one legitimate rental business. So they're not scattered, but it's just one big grouped business. That's the term that the IRS likes to use. All right, moving on. The status benefits, it converts passive losses to active. I've already spoken about that. And yes, it's audited. This area is heavily audited by the IRS. Documentation is key. I've already spoken about the rest of the concepts. I'm moving a bit faster because of time limitation. Okay, real quick on the passive income allowance. Another great concept for people who make W-2s or even business owners who make not more than 150K. So if you make, say, 100K from your W-2 income, and you do own a couple of rental real estate properties, and your filing status is single, doesn't matter if you're not married filing jointly, you're just single, and you own properties, you can still take something known as the passive income allowance. And what the IRS says is that you can take 25,000 up to 25,000 in terms of allowances from your from your adjusted gross income. So if your income is, and I think it phases out at 150K. So the minute you jump the 150K AGI mark, this allowance is no longer available for investor clients. So it's a win-win. So if you make less than 150K, you still get the 25K in terms of allowances from the IRS. And if you make more, then you try to get the rep status, is what we tell the clients. Yes, the rule does say passive losses. Another great question I get is, do passive losses offset against passive gains only? Yes, they do, unless you claim the real estate professional status for yourself. All right. Another great way to defer capital gains taxes is by investing into opportunity zone programs, also known as qualified opportunity zone programs. And this happens if you invest into a fund. There are people who organize, it's very organized. So you have to invest into certain types of properties located in certain zones as designated by the IRS. And it's on the IRS website. You have to invest into those kind of properties in those kind of zones, and you have to organize yourself into an LLC, into a OZ kind of a fund, and you have to invest within 180 days of sale of property. So you're selling your single family home. Example again, you have 500K, you made gains of, I don't know, you made gains of say 300K. You don't want to pay capital gains taxes on 300K. You can invest into a QOZ, which is a qualified opportunity zone program, within 180 days of sale of property. And you hold your investment for 10 years within that fund. The longer you hold your investment, the more the chances of you deferring those taxes, those capital gains taxes into the future. Basically, you don't pay anything. So the minute you sell, you invest. No capital gains taxes paid. Poof, all gone. All right. So you defer gains, and there are certain deadlines. It's a little complicated here. I won't take much of your time, but the 2026 is the final date for you to defer taxes. The people who are already in such programs, they can defer taxes all the way to 2047, which is, I don't know whether I'll be alive by then or not, but whatever. And then, this is a great way. I have clients who do, residential and commercial properties, and they end up deferring taxes using this program. It's a very exciting program, and the exit strategies are also pretty, it's simple. You just have to invest into such properties. It's not suitable for flips or short-term strategies. Definitely a long-term hold, 5 years, 7 years, 10 years. And you must have a long-term hold mindset. I apologize, I'm moving a little fast just because of time restrictions. And then the since we're talking tax strategy, it's a freebie session here. And I'm sharing all these, fancy loopholes with you at no cost. You can use cost seg and bonus depreciation. So you can combine both the strategies to create those paper losses. And trust me, I mean, you can see major results on your tax return. You can also think of claiming the real estate professional status. That's another great strategy. And you can use a 1031 exchange. Or you can use all of these strategies in 1 year itself, assuming that you are making a huge amount of gains on sale of your properties. So you can combine 1, 2, 3, 4, or you can combine all of them together, depending on what works for you or what doesn't. So what are the key takeaways from today's discussion? Real estate definitely is a very powerful tool to offset against your W-2 income, regardless of how much you make, doesn't matter. And then you can stack up strategies, because that's what tax planning is all about. Tax planning is all about stacking on one on top of the other. Bonus depreciation with cost seg, with real estate, with QOZ, hold the property, don't sell it right now, those kind of things. And then, 1031 exchanges and QOZ are great tools for deferrals or actually eliminating completely, and then just passing on those properties to your heirs, to your children, grandchildren, completely tax-free. So again, a very great tool. It's a great tool for inheritance planning as well. This is where you can find me. My name is Gunveen or 𝗕𝗲𝗀𝗳𝗶𝘀. I don't know why the CPA is coming in. I'm sorry, I apologize. I'm an enrolled agent, but yes, I do have a team of CPAs who work for me. Currently, we are based out of North Houston in the Spring Woodlands area. And we are also based in LA. That's my website. That's my email, gavtax@gavtax.com. And so if you need help in building a real tax smart real estate plan, feel free to get in touch with me.